Hello and welcome to Unblocking the Chain. I'm Ash Cooper. I'm excited to have you here for the very first episode of our brand new podcast. If you're curious about the intersection of traditional finance and digital assets, you've come to the right place. But I'm not alone. The podcast is a collaborative effort and I'm thrilled to introduce my co-hosts. First, we have Michael Prendiville, the Chief Investment Officer at JellyC, with an extensive background in both traditional finance and digital markets. Critter, welcome.
Coops, bloody good to be here. I feel like a guy who's very excited, a guy who's got a can of VB in his left hand and a shiny pair of tongs in his right hand. So I'm ready to go, and welcome to all the listeners out there.
Thanks, Critter. Also joining us, Drew Bradford, the Chairman of JellyC and the CEO of Catena Digital. Drew's been leading efforts at both companies to integrate digital assets in traditional finance. His insights will be invaluable, how these two worlds come together. Drew, welcome to the podcast.
Thanks, Ash. It's a pretty pivotal time in finance at the moment, and I look forward to taking our listeners through all the opportunities and warn them of some of the potential pitfalls.
Fantastic. Nice suits, by the way, too, gentlemen. Good to see you. You've still got the traditional finance. So let's start talking about why we're doing this podcast and what we're trying to solve for our listeners. The financial world is undergoing a massive transformation with the rise of digital assets like cryptocurrencies and blockchain technology. With all the noise out there, it can become overwhelming. And to figure out what's important and how it impacts your financial future. Critter, how did you come here? How do you think about digital assets?
Well, Coops, it's a good question to start with. There's a lot of benefits from the blockchain. Things like cost efficiencies. The blockchain, spreads throughout the whole world. It gives opportunities for people who are not banked. Gives opportunities for people in emerging markets. We may not see the efficiencies here in Australia because we have a fantastic banking system which is efficient. But for all the people out there that don't have access to, to be able to send money around the world, to be able to earn a yield off their investments, the blockchain has the solution.
Great, thanks, Crit. Drew, you're coming, from very senior positions at both Deutsche Bank and National Australia Bank. You're in quite a unique position about that transition and how you think that can, obviously sitting in senior roles, you saw how banks work and then moving into the digital asset space. So,
I think, as Chris touched on, the efficiencies that the blockchain brings, you think about this, it's 2024, and doing a simple foreign exchange transaction on SWIFT can take anywhere at best 5 hours, but up to 2 or 3 days if it's a public holiday somewhere. Blockchain changes all of that. When the RBA did their CBDC experiment, one of the two things that came out of was settlement of financial instruments was an obvious need for a blockchain currency, a CBDC. Instantaneous settlement, none of this T+2 and none of the risks that happen over that 48-hour period of settlement and clearing. All of that goes away with blockchain.
Yeah. I think we all agree on that. So I think probably delve into the next question, and we get asked a lot about this. You've both had 25 years plus in traditional finance, risk management, sales, trading, etc. If I was to ask you, what does that experience bring to the digital asset space? There's obviously trading, risk management, evaluating liquidity, macro influences. How would you pinpoint what that experience brings to digital asset investment management?
Should I go first, Drew?
Over to you.
Well, we're very lucky to come from the traditional investment side. We've had the experience to be able to go through the Russian crisis, the Asian crisis, to go through GFC, to go through all these, absolute calamity periods that have helped us identify risks in the system. So, for instance, coming into the digital asset space, 2020, 2021, 2022, when FTX and Celsius and Voyager, they had obviously they all went under. For ourselves, we're able to identify that counterparty risk before that happened and avoid that. In terms of, running an investment management business, that is critical, because as soon as you have a hiccup, like having money caught on one of the centralized exchanges, that's the end of your business. Okay, so for us, having the history of being through, I guess all of the calamities on the traditional finance space, it puts us in a good space to navigate, the crypto going forward.
Yeah, so it's interesting. I mean, I think there's clearly a lot of risk in the digital asset space, but you'd identify counterparty risk as the number one risk. Is that what you're alluding to?
Counterparty risk is definitely a major risk. You can't not look at market risk. You can't not look at the other risks. For instance, the custody risk. You can't not look at things like country risk and regulatory risk. There's the hacking risk. There's fraud. So there's so many risks in the industry that if you don't have your head in the right space and you're not looking to absolutely mitigate those risks the whole time, then you're going to come unstuck. And I guess that is the primary reason why you would use a fund to make an investment in this space, is because we are looking out for those risks. With our background, obviously being able to navigate these through the space of time.
Thanks, Stritz. Drew, you've been all over the world with banking. Europe, New Zealand, Tokyo, with Deutsche and both NAB. NAB, in your last role, you were involved in a digital asset set up in a stablecoin. So you were working in traditional finance on a stablecoin. How you obviously saw something there that would make it much more efficient. How do you think about that going forward?
So I know there is a group of people, a view that that crypto blockchain is a decentralized and separate from a traditional centralized finance. My fundamental belief is the blockchain technology is a new extension, and the same way as we had commerce before the internet, and now you sell either in bricks and mortar and you can sell online. We will have this in traditional finance, that blockchain will be an extension of traditional finance. It will just make it simply much, much more efficient. You've got programmable money. So you take away the settlement risk. Settlement can only happen if an asset and the currency swap at the same time. You don't say, I'll buy the asset today off a person and then say, I'll put my money in a bank account 2 days later for the asset. Everything happens at the exact same time. So you're just taking a lot of complexity out of it. So I fundamentally believe that blockchain will be an extension of traditional finance, and traditional finance will mold itself and just use blockchain for the settlement and all the great features it has. It's programmable money. So you're just removing a lot of the risks that Critter was talking about that happen in traditional finance. That's a timing thing. It'll happen.
So, I mean, I think that's interesting, and I think, our discussions are not so much about, blockchain take over the world and, it's going to be anti-establishment. I think what we're working on and educating on is actually this technology is going to help the traditional world, supplement the traditional world, not compete with it, which I think there's some conflict out there about that.
It will make traditional finance so much more efficient, and it will just reduce the costs. You look at for everybody. A great example for the everyday Australian, and we will see this every time we tap our cards, that 5 cents or 7 cents get added to your cup of coffee. That is a fee that goes to Visa or MasterCard, merchant service fees. On blockchain, you can do that for 0.1 of a cent. And so this will take, blockchain will allow an efficiency to take over in traditional finance that will make everybody that uses it better off.
25 cents over in Perth, Drew. Merchant fees on a coffee.
Unbelievable.
Unbelievable.
So Australians pay $4 billion a year in merchant service fees. Blockchain can remove that completely.
It's amazing. And you've got power in Perth as well. So let's just step back a little bit. Crits, can you tell us your background, where you've come from, how you came into the space? You know, obviously 20 years in the finance space, and then we'll get to Drew to run through his.
Actually, it segues from what Drew just mentioned on the cryptocurrency side. It really is just an extension. So back in 2018, I was trading a fixed income and currency hedge fund over in the Cayman Islands. Anyway, pretty much I had one eye on what was happening in Bitcoin. At that time, I wasn't a believer. However, the Bitcoin price became quite compelling when it went up to around about 18,000. So there was a lot of volatility in the space. And at the same time, in the fixed income and currency space, volatility was compressing and interest rates were almost at zero. So my eye started wandering, and I started doing a bit of research on Bitcoin and the sector. And really, I fell down the rabbit hole. In 2019, I handed back the money in the Caymans Fund, and I exclusively went down the crypto space. And ever since then, I've had a love affair, Coops, with crypto. And now it's not just Bitcoin. Now it's it's all the way down.
Yeah. I know you're a young man, but can you give us a little bit of a snippet before 2018 of what you did and your history in trading and risk management? Because I think it's important segue.
Yeah, so before I came back to Perth, I was in banking, and I went around the world. I started in Singapore, went to London, to Hong Kong, and then back to Singapore, and was on the proprietary trading side. And mainly focused at that point on the currencies. And then I came back to Perth and started up a investment management business, and the vehicle was out of the Cayman Islands. And that was a currency and fixed income fund. It was a discretionary fund. To put it in perspective, we were turning over around about 80 to 100 billion US every year. And returns were, say, 12 to 15% per annum with a Sharpe ratio above 2. So, we were, doing a good job of it. But in 2018, when, for instance, interest rates went to zero, volatility in the currency space went to, negligible rates, it became from a risk-reward perspective, knowing that I had all my money in this fund, it wasn't the dynamics that we wanted. So I would have to risk a lot to make a little. Whereas if I looked on the crypto space, there was a lot of volatility. There was a lot of opportunity in terms of yields and, arbitrage and fixed income, and basis. So it just made sense for me to swivel and pivot. And it's not like I've changed direction. It is just an extension of what I was doing.
Yeah, so it sounds like you risk a little, make a lot, which is the conversion from the traditional world.
That's right. We don't have to risk much in this space at the moment, but we can make a lot.
Yeah, great. So Drew, over to you. A little bit around your background, and I think probably then moving into, with all that experience across the globe, how do you think about that experience and monetary policy and how banks work and how the globe works financially? How do you evolve that into thinking about digital assets on the macro sort of level?
Ash, so I did uni in the 80s. I joined Bankers Trust as a graduate just in time for the stock market crash in October 1987. That was one of my first experience of market mayhem on the futures floor at the SFE. So that was an interesting start in life. I spent a decade at Bankers Trust in their derivatives area, and joined Deutsche Bank in 1999 when they bought Bankers Trust, and then spent 12 odd years with them floating around, mostly in London, but 3 years in Tokyo as well, and then came back to Australia to run the markets business at NAB. I guess my introduction to digital assets was I've always been a subscriber of Raoul Pal's GMI thing. I think it was about 2013. He started talking about Bitcoin, so that was where my interest started. What was this? And it was trading at $500, $600, $700. So I did buy 10 at $700 each, and then promptly lost them. Hence back to what Cripps talked about, keeping things secure. It wasn't actually, which brings you back about the macro point. I was a sort of a dabbler in the space. I invested in a couple of funds, and it was just interesting on the side, digital assets. In March in 2020, as basically every government in the world started dumping money into the system when COVID, you look at the cash injection. I remember sitting around with a group of guys on our management team and thinking Bitcoin's going to go through the roof because there's so much cash coming into this. Governments are just spending all over the world, debasing their currencies, and this was the thing that Bitcoin was meant to protect against. 21 million. And I remember sitting around this meeting, and we all thought Bitcoin's going to go through the roof, and it was about $5,000 or $6,000 at the time, and it went pretty much up to in the 50s over the next 12 months, and that's when I really started getting involved in looking at and understanding blockchain properly, as opposed to just having a little play on the side. And I just looked at the efficiencies, not from a Bitcoin maximal point of view, but just what blockchain actually did. I did a course at UC Berkeley that was all around blockchain strategies. And it just taught me that financial markets as a whole would be much more efficient if we used blockchain in the process. So that's when I started getting NAB to build a stable coin so we could transfer initially our own internal treasury, transfer assets instantaneously rather than taking days, much in the same way JP Morgan does with JP Morgan coin. And it just looks so much more efficient to me. It's interesting that for a number of reasons, and maybe we'll touch on later, that none of the traditional financial players, whether it be the banks or the super funds, after having a little poke around the space, are actually doing much about it. Hence why I'm no longer there.
So why don't we roll into that? Obviously, leaving running markets at global markets at National Australia Bank, big job, and there's not many of them at that level. Made the leap into crypto. You obviously believe in it strongly. What was the trigger to get you to do that?
Well, I think part of the problem in Australia is crypto is still unregulated. And if you're a bank, you actually have to operate in regulated markets as opposed to unregulated markets. You're supervised by APRA. You can't play around. So it was going to be literally years before the banks. It's still going to be years before the traditional sector dives into blockchain properly. It will happen once we get the payments modernisation regulation through, which will be late 26, maybe early 2027. That's when the traditional sectors come in, but that's a couple of years away. So, here's an opportunity if you're going to dive into the space early to get involved with the infrastructure, actually hopefully help shape the regulation. It's interesting around the world which countries are diving into the space. If you look at it, Europe with the passing of MiCA, so 27 countries in Europe have got proper regulation in place around digital assets. Japan, Hong Kong and Singapore are also got legislation in place. Actually, Hong Kong's got trial legislation, but Japan and Singapore has. The Middle East has legislation in place. So there are countries around the world that are diving in, but in Australia, we're 2 years away. So that's an opportunity to get in there, shape it, be in early. To me, it's like you're watching, you know that the market will adopt, financial markets will adopt blockchain because the technology is just too good for it not to happen.
Yeah,
Troops, I've been telling everyone that Drew dropped out of banking because he wanted to join yourself and I and be like the cool kids on the block.
Oh, there's a bit of that too.
And so Chris, just sort of segueing, obviously had a lot of macro influence about how you think about markets. So I think there's two things here. Obviously, for the regulation bit, and let's say incumbent institutions definitely need that. We understand that. If we were sitting here in 2 years' time, where do you think we are? What's the state of crypto in Australia? And probably segue a little bit into in the world.
I guess Drew's touched on it there. In terms of the Digital Act, and I'll talk in terms of my trustee hat at the moment. At this particular point in time, it's difficult for any regulated institution to participate in the space. Okay, and that holds us back in a lot of different areas. Like, for instance, with JellyC, we want to tokenise the infrastructure fund. Okay, now there's impediments in doing that, and by tokenising the fund units, for instance, there's a lot of benefits in doing that. Okay, so there's real time, a real time ability for investors to be able to buy and sell fund units. Okay, and for them potentially to custody their own fund units. There's the ability for them to be able to, for instance, leverage off their holdings in a fund. Okay, there's all of these benefits that will happen, but the legislation is not in place just at this point in time to allow it. In saying all that, we have just had a conversation with the terrific people at ASIC, and we are moving forward in tokenising the registry of one of our funds, and so we've got small steps in terms of achieving the goals, to push the space forward. So back to your question, I think that the end of 2026, when the Digital Act comes in, I think the big end of town, like Big Super, I think the wealth managers will come in en masse, and they'll have a small portion of their portfolios, let's call it somewhere between 2 and 4%, that will be a portion to digital assets. When that happens, we want to be positioned for that.
Yeah, great. And Drew, 2 to 3 years' time, you're obviously a huge believer in real world assets and stable coins. Where do you think we sit on those?
I think in 2 to 3 years' time, we'll be warming up for a wall of money coming into the space. And because in Australia, 2 to 3 years' time, we'll be getting the legislation. All crypto exchanges will have to have an AFSL. All of the custodians, everything will be regulated. Stable coins will be part of the regulation. And that regulation will either have passed in 2 to 3 years' time or about to be passed. So your traditional finance sectors, as Chris was mentioning, super, banks, will all start dedicating their investment slate into this space because it will save them, I was going to say millions, it will save them billions of dollars in operational costs by adopting settlement in blockchain, no clearing, you're taking away so much risk. And if you look at their tech stacks are actually layer upon layer as we've gone through technological improvements from mainframes to web-based to internet-based. There's layer on. Having all your assets on blockchain just removes that whole tech stack, particularly for custodians. So I imagine more and more real-world assets bonds, equities, or securities will be traded on chain, as we're trying to do with the fund. It is just so much simpler. So in 2 to 3 years' time, the traditional sector will be preparing for that. It won't have happened. It's probably a 7 or 8 year away event, but traditional finance en masse will be preparing.
Do you think you could put old Aston Martins on the blockchain and use as collateral?
Absolutely. I think anything is going to be able to be used as collateral once it's on chain. It's going to change the way bank accounts look. If you look at your bank account now, if you've got a house as security, you pay one level of interest. If you've got a car or something that's a security, you pay slightly higher. If you want to put equities as a security, margin lending, you pay an even higher rate. And if you've got no security at all, a credit card, you're paying 22%. Once everything's securitized, you will have all your digital assets in one bucket. You'll be paying one set of interest off a secured bucket of assets. It will make finance so much simpler.
I mean, I think that's the interesting thing. To me, it's so simple. Actually, real-world assets, digital assets is a pure collateral, right? Real-time mark-to-market. You know where they are.
Absolutely.
So do the banks become the custodians eventually as the major lenders?
I think if we look at what a digital custodian looks like, that could be a bank of the future where you keep your digital assets all in one spot, and it could be your old car, it could be your house, your art, whatever you've got that's digitalized in a thing, and then you borrow money against that. You can have that's secured against a portfolio of digital assets, and that becomes your bank account. I see that as what a bank looks like in 5 or 10 years' time.
The benefit with that as well is imagine having all of your digital assets in one wallet, whether it be custodian or your own wallet, and then imagine, from insurance perspective, you've got the provenance or the deeds sitting in your wallet. It is just one click, and you've insured all those assets. In terms of identifying the deeds, they're all there. So there's no way that you won't get a payout if something happens to, for instance, a particular asset.
Yeah, I've had that discussion with reinsurance groups. So they say most of their efforts or resources are on clarifying that actually those assets were held by the owner, like literally 70 or 80%.
Yeah.
So if you
even your Jimmy shoes, you've got your handbags, you've got anything really that's over $1,000 that can be sitting in that in that wallet.
Are you worried about your Jimmy Choos getting stolen?
Did I say that right? Jimmy Choos?
Yeah. So this is just the beginning of our explanation in this podcast. We'll be tackling many of these questions and helping you stay ahead of the curve in the rapidly changing world of digital finance. So a huge thank you to Critter, Prendiville and Drew Bradford for joining me on the journey and sharing their insights.
Thanks, Ash.
And of course, thanks to all of you for tuning in to the first episode of Unblocking the Chain. Until next time, keep your mind open and stay curious about the future of finance.